As the picture shows, we live in difficult times where the macro environment and the macroeconomic and political environment have challenges, and that is a strong reflection on the performance of investments. This is Jeremy Squire reporting on the quarterly report for Wealth Associates Asset Management for the second quarter of 2017. Wealth Associates has 4 fund of funds, which are asset allocation multi-manager funds, which cover 4 different risk profiles: cautious, moderate, balanced, and growth. And they employ a building block approach utilizing 5 different asset classes and a number of managers, all of whom are deemed to be the most expert and competent in managing those different asset classes. The slide that you see illustrates the different asset allocation of the 4 different funds. For example, the growth fund is the highest risk fund. It takes on the highest risk and therefore has the highest equity exposure and the lowest exposure to cash and income assets. Whereas the cautious fund is the least aggressive fund and therefore employs a much higher exposure to cash and income and a lower exposure to equities. This slide reflects the fund weights that are employed. So Wealth Associates have 13 different asset managers employed in the fund of funds across the asset classes. Again, the asset classes are SA equity, bonds, listed property, cash and income, and global assets. And each one of the funds has an allocation to those managers. And one will see that, again, the balanced and the growth fund have higher exposure to the equity asset class, whereas the cautious and moderate fund, which are low risk portfolios, have higher allocation to bonds and cash. A very important aspect of construction of the portfolios is to make sure that the actual asset managers engaged have a low correlation to each other in terms of the methodology that they apply, because we have different equity managers, and if we had equity managers who all managed equities in the same fashion, that would be somewhat pointless. So what this slide shows is that, for example, 361 obviously has a correlation to itself of 1, but its correlation to, for example, core shares is 0.03. So that shows an extremely highly uncorrelated style. Conversely, there's a reasonably high correlation between Truffle and 361 and Glorium and 361, but the positions are still sufficiently uncorrelated to make it relevant. Another important aspect employed in the equity building block approach is the use of what are known as equity factors in building the portfolios. The major factors that are present in the South African market are value, momentum, low volatility, and quality. And let me explain briefly what each of these are. So value is the factor which is present when you have a manager who will look for those shares which they believe have a price which is at a discount to their inherent value, and therefore trade typically on low price earnings multiples and have high dividends and so on. The momentum factor is symptomatic largely of human behavior, in that when a share gets to what is deemed to be fair value, very often the share price runs substantially beyond that value because of the momentum of purchasers who are attracted to that fund and the belief that winners will continue to succeed into the future. So momentum is a very important and dominant factor in the South African market. Low volatility talks to those shares which have somewhat defensive qualities and which are less prone to cyclical influences, so the share price will tend not to react dramatically to events and you have a much more smooth profile of return. And then quality talks to typically the longer standing, larger companies in the market which have fantastic brands, great management, great track records, and very, very strong balance sheets. An example of quality would be something like South African breweries, for example, and Anheuser-Busch. The use of factors is very important because the dominant factors in the South African market tend to be momentum and quality. Value is well documented by the likes of Warren Buffett as the factor that one should employ longer term. But the reality is that whilst the market is perfect in the longer term, it's relatively imperfect in the shorter term. And so you often find that pure value managers will have long periods of underperformance, but we need to make sure that in those periods where they actually do confirm and do show outperformance, that the factor is not excluded from the composition of portfolios. And so the introduction of certain of these managers is very specifically designed to make sure that there is presence of all of those factors at all times. This graph shows that SA equities have been trading in a very flat range for the past 3 years, and most growth portfolios rely heavily on equities to give them the inflation-beating returns. So it's no surprise that portfolios have not performed according to their longer-term expected inflation plus factors over this period of time. Next two graphs show the asset class cumulative returns over a 5-year period and over a 12-month period. And investors are often reminded that if they are investing for the long term, they must focus on the long term. And it's very difficult for people to, however, to actually ignore what happens in the shorter term. So what this shows is that over the 5-year period, your growth assets, being equities and listed property, were the main drivers of returns in portfolios, and that bonds and cash were much more pedestrian but stable in terms of their contribution to the returns. However, if you look at the 12-month period, that position is inverted completely. And that's actually quite normal in periods of underperformance of growth assets. We've seen it before and we will see it again. So in this instance, the biggest driver of performance has been bonds and cash, and the lowest driver of performance have been listed property and equities. So the question that's always asked is, shouldn't the investment managers actually be inverting the allocation of assets to reflect that short-term performance? And that's what's called trying to time the market, and to do so would in fact be irresponsible. But what has happened, and certainly in uncertain times, the Wealth Associates portfolios are definitely more conservatively positioned. So the exposure to equities is less than what the long-term exposure would be, and the exposure to the more stable asset classes is higher than it would be over the long term. And that gives stability, and it somewhat stabilizes the returns. Another way of looking at the attractiveness of the equity market is to assess the PE ratio, or price earnings ratio, of equities. And what the next two graphs shows is South African equities and global equities. South African equities are currently trading outside of the dotted band, which has a low of 12 and a high of 18, and are trading around about the 20 price earnings ratio. That means that they're relatively expensive compared to history. And that therefore means that South African equities represent less value currently than they have historically over time. Conversely, global equities are trading well within the acceptable range, and so global equities are deemed to offer much greater value, and as a result of that, the investment managers have a far greater orientation towards global equities at the moment than South African equities. That said, there are constraints in terms of the amount of global exposure that one can have. This graph shows the long-term performance of the JSE relative to global equities. And despite the current difficulties, the history shows us that in fact the South African market has performed exceptionally well in dollar terms relative to global markets, and has significantly outperformed global markets over this period shown from 2002. And in fact, for the past 100 years, statistics show that the South African market is in fact the second best performing market in the world. So it shows that South African equity markets are actually a fairly desirable place to be invested. A big influence on the level of South African markets is not only the amount which South African investors invest in JSE and in the bond markets, but also the participation of foreigners in our markets. And South Africa is a very liquid market, and foreigners are big participants in the markets. So these two slides show that the history of foreigners' participation in the JSE, and what it shows is that in June, foreigners were net sellers of SA equities, but in fact that trend has actually been present for about the past 2.5 years. And that has a significant impact on the performance of the JSE. And is a reflection of a number of things. One would be the relative value offered by the JSE, but the other would be value offered by other equity markets around the world. There's also an element of concern regarding policy decisions within the South African market. Quite interestingly, the bond market actually shows a completely different trend. And whilst you can't ascertain a specific pattern over the recent terms, I mean, it's clear that foreigners are very attracted to South African bonds. And the main reason is that treasuries in the developed markets are paying them 1 and 2 and 3% if they're lucky, whereas in the South African market they can get yields of 7.5% to 9%. The patchiness, however, is reflective of periods where foreigners were sellers of bonds, reflected of political events which have unfolded, such as the firing of Minister Nene in December 2015, various downgrading of South African bonds by the rating agencies, the firing of Minister Gordon, and other events. But despite that, foreigners still show an attraction to South African bonds. The important thing, however, for South Africa in terms of our long-term performance is faith in the economy and policy certainty. And this graph shows that South African manufacturing is very much a proxy for our economy as a whole. And the sharp decrease in manufacturing is symptomatic of the fact that businesses are simply extremely reluctant to invest capital in factors of production. So what we've seen is that a lot of South African corporates have extremely healthy balance sheets, but the investment that they are making is typically in terms of foreign investment, where they're buying stakes in foreign companies which can complement their portfolios and earnings. So South Africa urgently needs to have a return of certainty in terms of the political environment and the economic environment by leadership, so that people can start reinvesting in the economy, because that's the only way that the economy will pick up. The Rand is obviously an extremely important factor in the performance of investment portfolios, because not only do the portfolios have a relatively high exposure to offshore investments, but indirectly there's also an extremely high exposure to the Rand relative to other currencies, because by some measures apparently 70% of the earnings of the top 100 companies on the JSE are in fact earned in foreign domains. So if the Rand is weak, then it tends to have a positive impact on the portfolios. If the Rand strengthens, then it has a somewhat negative impact on the portfolios. And this graph measures the Rand relative to the three major currencies in the world, being the pound, the euro, and the US dollar. And the long-term trend has been a decline, and some people are somewhat surprised by the strengthening of the Rand in the past 18 months to 2 years, because it seems to come against a very negative economic and political environment. But what it does show is that the Rand is really an extremely liquid currency, and it will find its own level relative to the demand and supply factors that prevail in the market. An important consideration in the construction of portfolios is the ability of those portfolios to give investors inflation-beating returns. So this graph shows the South African inflation rate and interest rates, and the important thing here is that inflation has come back into the targeted range. So the South African Reserve Bank targets a 3 to 6% for inflation over the long term. But for a significant period, the inflation rate was outside of that, and that is a hugely detrimental effect on the real wealth of people. So the employment of the different asset classes is extremely important in terms of ensuring that the long-term performance of portfolios will actually give clients inflation-beating returns, regardless of whether it's the cautious, the moderate, the balanced, or the growth fund. And whilst in the short term there has been underperformance, particularly in the balanced and the growth funds, the moderate and the cautious funds have actually somewhat outperformed inflation in the shorter term, but still not at the targeted range, because the growth factors in the portfolios, being equities and listed properties, have not performed at expected levels. We live in extremely interesting but trying times because there's tremendous political uncertainty. With it, there seems to be a lack of economic direction, and obviously the fortunes of all South Africans are governed by what happens at the leadership level. So we expect that in the lead up to the elections, that this uncertainty will continue. But, South Africa's been through this before, and if one reflects back in history, we've actually been through probably much worse times. One just thinks of the Rubicon years in the 80s, uncertainty leading up to the democratic years post 1994, and those all had tremendous impacts on the performance of investments. The ability of South Africans to actually prevail through tough times and to work together is extremely important, and we believe that the good of the good people will prevail over the factors which are extremely concerning currently, and the future trajectory for South Africa, its economy, and of course your investments is in fact good, but patience is a necessary component. This is Jeremy Squire representing Wealth Associates Asset Management. Have a good day.